You are listening to KeyStone Stock Talk Show, episode 268. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again. We have a busy show just ahead of the second installment of our new small cap 10x stock investment live webinar starting this week. After a sold out show last week, I will kick off the festivities with a quick look at small cap stocks. Quite simply, what the heck are they and why to invest in them? On the heels of our just released Canadian REIT report, Aaron returns with a segment all about investing in Canadian REITs. With Canadian rates moving lower, the REIT sector may hold some intriguing options over the next year. In our Stars and Dogs segment, Brennan reviews and answers a listener question in the process. Our star, ZOMD Technology, symbol ZOMD on the TSXV venture, a marketing tech company, which is up huge in 2024 and up 150% over the past month. But this follows on the heels of a horrible 2022 and 2023. Brennan takes a look at the recent growth and whether the business is worth another look. Brett has our dog of the week, Super Micro Computer, symbol SMCI on the NASDAQ, a provider of application optimized high performance servers and storage solutions. We previously reviewed the stock on the show in March of this year. At that time, it was trading at $1,000, around that range, just over, up 283% on the year. 6 months later, the stock is now down 58%. Brett lets you know why the shares have been on such a roller coaster ride to start 2024 through the year and where the ride may be headed. All right, let's get to the show. My co-host, Mr. Aaron Dunn, is back and in the flesh. It's not just flat done again this time. And the Killer Bees, Brett and Brennan, are here as always. How are you guys doing?
Good. How are you?
Good.
Kids
flat done.
Back to school today?
Yeah. I had one
Pretty
go
big
to
deal
university, which is a big deal.
Oh, wow.
For this household, and then one going into grade 4. Yeah, so
Yeah.
cool. Yeah.
And
Yours?
You still drive
Eric to university
every morning?
Yeah.
It's cool.
Yeah, an hour and 45 minutes in traffic. It's just a breeze, right? Yeah. No, he's living up there, which is the real change, to be honest, to be living on campus for us.
That's great. Yeah.
Yeah, it's good. Hopefully it's a good experience. He's got his, we were just talking pre-show here. He had his 4 friends that he made from about grade 6, 7 on, and they all got into UBC. So pretty cool that they can all get there. He's rooming with one of them up there. They're good guys. So good group to be with and branching out up there. And he probably doesn't want me to talk too much about it. But nobody's listening anyway, so who cares, right? So yeah. there we go.
I'm just thinking right now in my head of just some of my first year university stories that I can't say on air because they're just, moving out, living with your buddies, away from home, and
instilling confidence in Ryan right now.
Yeah, thanks for that.
Well, Ryan's been there too, so this is true, but I was just laughing in my head about some of the stories of my boneheaded friends and myself.
And it continues today. Today. So.
I'm sure Eric will make smarter choices.
Yes, that's what we hope, right? We can always hope. Smarter decisions than we made or the Brennans of the world. All right. That's about it. And your kids aren't back yet, Aaron. So
no. There's some upgrades still going on at the school, so it's going to be two weeks.
The extended summer, I'm sure you're loving that, right?
They're thrilled, yes.
You're thrilled, right?
Yeah. I'm staying above water, that's all.
Trying to keep your head up, yeah. All right, well, we are extremely pleased. Again, this is the second of our 10X webinar series. There's one this week, Thursday the 5th. 7 p.m. Eastern, 4 p.m. Pacific. The tickets sold out last week. They're almost sold out this week. We have a room limit. Great turnout, which is great to see. So get your tickets before they are gone. We had a poll from last week, did we not, Brett? The question was, so far in 2024, has the economy performed better or worse than you expected? But you're going to put that up there and tell us what our trusted listeners...
Yeah, so this one I'd really say comes off. I would say at the start of the year, the optimism was quite, well, not optimistic, quite low. And ironically, today, of course, we have one of the biggest falls in the stock market in the year when we're recording this on September the 3rd. So good timing for this one. So the question was, like Ryan said, so far in 2024, has the economy performed better or worse than you expected? At 54% of our viewers said better, 23% roughly what I expect, and 23% worse. So overall, people actually were, like I said, pessimistic at the start of the year compared to how they are now. It's performed better. And I think that's lines up with a broad consensus across just not even our viewers, because sometimes we do have those weird quirks within our viewership. I think this one's pretty good consensus across inside our viewers. But as well as I would like to comment on is, I always like to refer as the economy, even though that's quite a vague term, and you'll see other talk shows and financial talks say the economy, but that can mean quite a few things to quite a few different people. Is how their job's doing, and then you have the geographic. If you're in Toronto, that'll be different than some booming city like PA or Prince Albert, where Brennan's from. So you can have some geographic differences then, of course, between Canada and the US for our viewership, things like that. So things, when you're just referring to the economy, even in other talk shows, like I said, it can mean many things to many different people. So I like to keep it quite vague, but really it's really more a perspective thing, I would say, what I want to get at with this question.
Yeah, and it's quite contrarian today with everybody saying better and the stock market being down today. But, you know, it could flip on its ear for that tomorrow. But yeah, I mean, I would say that given the rise in rates that we've experienced over like a 16-month, 18-month period, I think it's performed, you know, slightly better than what I would have expected. But sure, we'll see. Talk to me at year's end and we'll see where we are there.
Yeah, and like even Ryan and myself were talking on, I guess, last week on Friday, and just about, you know, the US yield curve. Like it's been inverted for more than 600 days, which I believe.
Yeah, and I think we'll talk about that next week. We okay, got a kind of busier show. No, talk right now. You can. I meant like we'll talk deeper.
You cut me off.
No, it was. That's not what I meant.
Regardless, it's just it is interesting seeing, you know, basically a lot of people just say, oh, well, I mean, we're not even taking this into account, where again, usually a yield inversion will you know, kind of indicate a potential recession or a looming recession. Again, this isn't always the case, but you know, I think that this is the longest inverted yield curve that we've seen ever. So it's quite interesting, you know. So I mean, even just based on this poll, you know, I think that I would be maybe a little bit pessimistic, but I mean, again, does that mean that you should be selling your stocks and not in the market? No, that's never the case generally. But anyways, we will talk, like Ryan said, in a future episode about it more.
Yeah, and I'd have to confirm, but I think even going back 5-6 years, the yield curve was inverted as well, because there's a lot of talk about that, whether or not recession was looming, and it didn't happen back then either. So it's you know, it's interesting to know. I mean, sometimes you have these statistical relationships, they don't always hold. Yeah, but it's certainly something to keep in mind. And as Ryan said, we'll look further into it next week.
Yeah, just on the statistical relationships, there's only, I think, like a dozen times it's happened really in modern financial history for Canada. So it's not like you have a massive sample size. Normally you want to look for something like N over 30. That's normally where you'll see a lot of cutoff for statistics.
Yeah, and if this happened 50 times and every time, then he'd be like, well, gosh, yeah. So you need more of a sample size, is what you're saying. Yeah. Cool. All right, let's get to, I'm going to talk about, I might as well, we don't have anything else we want to talk about before we want to get to the meat of the show, right?
Let's get into
I'm going to present then. So I'm going to talk about small cap stocks. What are they and why to invest in them? We've been hammering on this study that came out in the last year and a half from Jenga Capital Partners, why because it aligns with the way we have looked at the market, and one of the reasons why we look at small cap stocks, but not specifically just small cap stocks, profitable small cap stocks. The stats from that report were that 87% of stocks that have jumped over 10x or 1,000% over the past 10 years began as small or micro cap companies, and 82% of those were profitable at the start of their ascent, where they started going up. 91% of those had some history of profitability. So if you're searching to find the next 10x stock, the key is small, growing, profitable, and undiscovered. But we talk about small cap stocks all the time. Why don't we define them first in terms of the way the market defines them, and then we'll define them quickly in our research and why potentially small cap stocks have that outperformance. So let's look at defining what small cap stocks are. Well, when I say cap, I just mean market capitalization, a measurement of company's size, total value of a company's outstanding shares of the stock, or stock price times shares outstanding. Now, there's U.S. market tiers that we look at here. The mega cap stocks, these didn't even exist a decade ago, but stocks with a market capitalization or market value of over 200 billion would be considered a mega cap stock. So the Alphabets, the Apples, the Microsofts of the world. Large cap, market value between 10 billion and 200 billion. Mid cap is market cap between 2 billion and 10 billion. And small cap is market cap between 250 million and 2 billion in the US. And these figures are in US dollars. And then we're looking at the micro cap to be anywhere essentially under 250 million in the US market. Let's look at those tiers in the Canadian market. We don't have mega caps essentially in the Canadian market, just large caps, market value of above 10 billion typically. Mid cap market value between 1 billion and 10 billion. Again, these are in Canadian dollars. Small cap is typically between 150 million and 1 billion. And then the micro cap is typically less than 150 million. Now, in terms of our coverage universe, let's take a look at a couple tiers here that we look at. When we are covering Canadian small caps, that's micro all the way up to mid, the market value is between right down to a company that might have a $5 million market cap if it had some liquidity, and up to about a 2.5 billion. So when we're in the small cap sector, we're roughly looking at 2,200 stocks that we are drawing from. And then we look at the profitable companies from that sector. We're monitoring all of them, but that's typically what we're looking at, that many stocks to monitor. US small cap coverage. This is coming soon. We're going micro all the way up to mid. Market value between 5 million, right down to the smallest of the small, right up to say 10 billion, roughly. That's roughly 10,000 individual stocks. We'll narrow it down to profitability in those companies, but we are monitoring those companies for when they transform themselves into profitability. So now you've seen that outperformance. I quoted those 10x stocks, more of them coming from the small and micro cap sector. Why the outperformance? Now, while the data shows, again, that small cap stocks do outperform, in particular, are the arena where you can find potential 10x stocks. But there's no silver bullet as to why the outperformance. Here are some of the top reasons that I can go through. Higher growth rates or prospects. Due to their size alone, small caps typically have higher growth rates than larger companies. It's not always the case, but it's easier at a basic level to double earnings from, say, $1 million to $2 million than it is to double earnings from $1 billion to $2 billion. So kind of just the law of large numbers there. However, the market often underprices small caps relative to similar larger companies. This means investors are typically getting better value for their investment dollar with the type of small cap companies that we recommend through our research service due to their potential growth, which is often not fully recognized by the market because of their lack of analyst coverage. So again, other reasons for the outperformance, that we just touched on it, that lack of coverage, it creates a greater chance of finding a mispriced stock. In many cases, KeyStone is often, when we discover a stock, a small cap company, micro cap company, we're the initial research or the only official independent coverage on a stock, and almost always, like I said, the only independent analyst covering a stock. Compare this to the, even hundreds to at times thousands of analysts analyzing or following large cap stocks. You can immediately see why the potential to find an undervalued or under-discovered, under-followed gem is far more likely in the small cap segment of the market. This is one of the primary reasons why we apply our fundamental research to this area of the market, where we can truly add value and find the best growth and value stocks for you. Now, additionally, big players and some funds are restricted or just unable to buy at the micro to small cap level. Like Buffett has said, he likes to play in that area, but he can't play in that sandbox anymore because he's just too large. You would have an advantage here buying smaller companies. You can buy before the institutions and often end up selling to them in the future. That kind of flips the old axiom on its edge. Let's look at other reasons why there's outperformance. It kind of goes deeper. I'm going to let you in on a little secret. Banks often act in their own interest. The financial industry is most often, like I said, acting in their own interest, not yours. Individual clients not acting in their interest. Their biggest clients are big companies. This is the primary reason doing financing for those companies that you can see a lack of interest in this sector from larger institutions. Small caps are generally less covered than mid to large cap companies. The banks or boutique brokerages, those that raise capital for public companies, they see more money in funding large cap stocks. Why not take commission on raising 500 million or $1 billion for a large cap versus 5 or 10 million for a small cap? This equals less coverage. Less coverage equals less knowledge of the stock, which creates the opportunity for a mispriced security or stock. Now, additionally, because the big banks keep getting bigger, they are historically less interested, like we said, in small caps in general. At this end of the market, it's been dominated by kind of boutique or mid-sized brokerages, which is an area of the market that has been shrinking considerably through consolidation over the past several decades. So the total number of analysts is shrinking, again, leading to less coverage and the chance to find that mispriced stock. We will note great growth stocks do not stay mispriced forever. For example, companies like Hammond Power and Expel, which came from our research, had literally no bank coverage or brokerage coverage, period, when we put out our initial buys on the stocks. Let's look here. This is the initial report on Expel, another company, no coverage, $1.42, not long ago in 2017. Again, our update on the stock here. Now, the stock trades no coverage at this point. It now trades at over $46, up 3,200%. The stock did not ever receive any coverage, big bank coverage in Canada. It is now graduated to the NASDAQ. Boyd had basically no coverage on this original recommendation at $2.30. Often profitable small caps receive the least coverage. Again, and I keep harping on this, this is our best opportunity to find those potential 10x stocks. It's just the big banks being the big banks. I encourage you to follow the money. The more profitable a small cap is, actually, the less likely it is to need capital. If it does not need to raise capital, the big banks and often even the shrinking brokerages, those boutique brokerages, will not cover these companies until they are far too hard to ignore. Again, these are great opportunities and opportunities that continue today. I'm going to give you an example of one. How about a recent example? This is 1 year ago, virtually to this date. We issued a focus buy on this company, Cipher Pharmaceuticals. There was no coverage on the stock. There had been in the past, but it was abandoned. In fact, the last brokerage report on the stock called for a significant decline in the core business, something that has not yet happened. Cipher was recommended at $3.89, bought for under 5 times earnings. 50% of its market cap was in cash and no debt. It says right there it trades at $16.90. I think it's moved up to around $18. It's literally the best performing stock on the Toronto Stock Exchange over that period, about 52 weeks. So why was it not covered extensively? Again, like I said, the balance sheet was great, roughly $50 million in cash with a cash flowing business, no need to issue stock, so no money in it for the big banks, and a great opportunity to find a mispriced stock. And it could become the next 10X stock. It's up already over 340+% in 1 year. It serves to illustrate my point on where you can find these great companies. All right.
Yeah.
Thank you. And then
just one thing that I would say is, you already kind of like stated it in your section there, your segment, but I mean, Warren Buffett, like during his 1999 Berkshire Hathaway meeting, he was asked a question from the crowd. If you had to start all over again with $10,000, how would you go forward? And he basically said he would start by going through companies that started with the letter A and go through to the Z's. So going through every single company. And he says, I would start going right through companies and probably smaller companies because I would be working with smaller sums and there's more chance that something is overlooked in that arena. So, I mean, again, it's just exactly, summing up what you said there, but coming right from Warren Buffett's mouth himself.
It is in some ways the best and maybe the only competitive advantage that an individual retail investor has over an institutional investor. I mean, they don't have the technology, they don't have the resources, but you're more nimble with your capital because you're investing smaller sums, and those institutions, they'll have a minimum investment amount to make anything worthwhile. And in some cases, that's just too much for these smaller companies. But these smaller companies can grow into larger companies, and one day those institutions buy in, as Ryan just went through. But it's really the only competitive advantage that a retail investor has. Now, the flip side to that is that it's still, if you look at the entire small cap market or the entire micro cap market, the vast majority of the companies are not investment grade. So it's you have the advantage of being able to invest in these great little companies, but it takes a lot of research in order to separate which will be the potential winners or the higher probability winners from the ones that are just speculation.
Yeah, for sure. And that's why we give a base of profitability to as a starting point. And again, we've been harping over this for the last several weeks and in our 10X webinars. There's this old axiom that once a company becomes profitable, you've missed out on the gains. But again, I quote that stat over and over again. You're actually far better off to wait or have a company that has been profitable or is profitable if you're actually looking for those tremendous long-term gains. And that's not just me talking from experience. Again, that is the data talking. And then I like to use the data rather than just our experiences. Our experiences will tell us that too, but the data is very hard to ignore. All right. I think we can move on from that segment. Aaron's going to he's been conducting a very intensive, in-depth REIT report on the Canadian REIT sector. He's going to go over some of his findings, where the REIT sector is today, and we're going to enjoy that and then have some questions after.
Excellent. Okay, thank you. Happy to do that. So as Ryan said, we've just completed a major report on the Canadian REIT sector. And several times throughout the year, what we'll do at KeyStone is we'll target a specific industry or theme, and we'll do a sector report, which essentially involves looking at and performing financial statement analysis and other forms of fundamental analysis on every company in that industry, gauging the different growth prospects, and then providing potentially some recommendations as well as some top tier monitor list companies. So we just completed this for the Canadian REIT sector, our 2024 Canadian REIT report. And what we essentially do is we learn a lot about what's going on in the industry when we conduct these reports. So for Canadian REITs, what I want to focus on here, just some of the facts and the statistics or the information that we've been able to gather in terms of the current state of the market and what investors who are looking at investing in REITs are essentially investing in right now. So the Canadian REIT sector consists of 40 individual stocks. The total market value is about 70 billion of the entire sector. And then the average REIT in the sector is about 1.7 billion. The largest category are the residential or apartment REITs. There's 12 of these. And the smallest category is the industrial REITs with only 3 members. So 11 out of the 40 REITs increased their distributions over the last year. And the largest increase was from Boardwalk Apartment REIT, which has been under coverage since 2021. And that increase was 22%. 5 REITs eliminated their distributions over the last year, and one of the REITs did a distribution reduction of over 50%. In terms of valuation, the average price to FFO or cash flow is 12 times across the entire sector. Residential REITs are the most expensive on average with a valuation multiple of 15 times. And then the average yield is just under 6%, 5.8%, with an average payout ratio of 67%. So why don't we just talk about what REITs are? So REITs are companies that own income-producing properties, so they're landlords. They might own shopping malls, office, apartment complexes, industrial buildings, and typically publicly traded REITs that can be public or private, but the incentive that investors have would be a high yield, a high income yield by investing in one of the REITs. Now, REITs have a special tax structure. They avoid paying corporate income tax if they distribute at least 90% of their taxable income to unit holders. So it's tax advantaged in that way. Unit holders, on the other hand, they will pay tax on those income distributions at the full rate for regular income. So this would be similar to interest income from a bond or GIC, and this is a higher rate than eligible corporate dividends. So one of the first ways that we look at REITs is REITs can be divided into different categories, and it's really important to understand the categories because each one will have different growth opportunities and risks associated with them. So residential REITs, this is the largest category. These are apartments, some mobile home communities. Generally speaking, we like the residential REIT space because residential apartments are generally considered to be a defensive asset. Even regardless of what's happening with the economy, people need a place to live. So there is a defensive nature to that segment. And as well, residential REITs do generally trade at a premium valuation relative to the others, but good, strong fundamentals in certain regions in that segment. Then there's the retail REITs. So these might be shopping malls, other types of retail operations. Now, retail REITs have struggled somewhat over the last several years. They can be more economically sensitive, but then also there are trends like e-commerce that are driving people out of the shopping malls. Diversified REITs. So these are REITs that have exposure to different categories. Usually they're retail and office REITs primarily. And then office REITs. These are, of course, office buildings. Now, the office space has generally not performed great recently, because again, they can also be economically sensitive. But recently there's the work from home trend that has been impacting the office space. So higher vacancies in the office category post-pandemic than we saw pre-pandemic. Industrials, this is a small space, only 3 companies, but these can be warehouses, distribution facilities. Well, these REITs can be economically exposed. Industrial properties, particularly in key markets, have been benefiting from strong fundamentals and very strong rental growth. And then specialty REITs basically would be anything that falls into another category. So some of the key financial metrics that we look at specifically when we're analyzing REITs, FFO and AFFO per unit. So these are REIT terms, but this is basically cash flow and free cash flow per unit. And we're really looking for that per unit growth because this is what generates value creation for investors. A lot of REITs in Canada particularly are very good at growing their overall revenue, their overall cash flow, but on a per unit basis, there's no growth, and that's not going to provide value long term. Same property, net operating income growth. So this really measures the performance of the existing portfolio. Are the rents increasing? Are there good fundamentals there? Payout ratio, how much of their cash flow are they paying out to maintain their dividends? So if we're looking at FFO, we're targeting payout ratios less than 80%. Debt to assets, so analyzing the debt leverage. Debt to assets or gross book value, generally we're targeting less than 50%. Anything above 60 generally signals higher leverage. There's the interest coverage. So we're targeting a multiple here. This is another debt leverage ratio. We're targeting a multiple above 2.5 times. Anything below 2, again, we would say is higher leverage. Distribution growth. We don't have a target in terms of the company growing its distribution, but we do favor REITs that are able to maintain consistent distribution growth. And this is only about a quarter of the sector. 11 companies out of 40 last year that increased their distributions. And then, of course, there's valuation. We would look one of the metrics we would look at here: price to FFO, or price to cash flow, looking for reasonable valuations based on the underlying fundamentals. So, just looking at the REIT sector performance, this is a 5-year chart. What we've really seen is we've seen some negative volatility over the past couple of years. 2022 and 2023, the sector's down about 21% on average. This year to date, it's moved up about 5% or 4 to 5%. But just over the last couple of weeks or last month or so, it's come up about 17%. And a lot of what's been impacting REITs over the last couple of years has been the higher interest rate environment. So REITs are considered to be interest rate sensitive securities. They are negatively impacted by higher interest rates, generally speaking. So how do rates have an impact on REITs? Well, one, higher interest rates mean higher bond yields and rates on GICs, and these compete with other high dividend yield companies like REITs. So when an investor is deciding, say 3 years ago, whether or not to invest in a REIT or a GIC, GICs are paying about 0% back then. So it makes REITs look more attractive. A year ago, GIC rates were over 5%, which drives a lot of capital away from high dividend yield stocks. Reduced valuation, so higher interest rates, the way that the pricing estimation models work, this drives asset valuations down, and it also compresses valuations in the market. So whereas a couple of years ago, REITs may have been trading on an average of 15 times cash flow, now they're trading at an average of 12 times. It can mean also increased interest expense. Most REITs have their debt based on fixed rates, but as that debt matures, they need to refinance it, and they will need to refinance that at a higher rate, likely. Now, this takes a while. This is a gradual process. So it's not an immediate impact, but most investors are looking forward and factoring this into the decision of whether or not to invest. And then also reduce discretionary spending from tenants. So particularly if you're in the office or in the retail space, those are more economically sensitive areas. So higher rates mean less spending from tenants. Maybe some businesses aren't going to do expansion plans that would have benefited the REIT as well. So these are how interest rates will impact REITs. And as interest rates have been going up over the last couple of years, we've seen the sector valuations compress and prices on average come down. Now, just recently, we've seen 2 Bank of Canada rate reductions. That's expected to continue probably at least until 2025. The US Fed is expected to follow suit. So there is potential looking ahead that as interest rates start to decline, that this dynamic will reverse and it will actually be a beneficial environment to REITs. And this is likely part of the reason why REITs have come up in price over the last month on average. So this is the reason why we conducted this research at this time. We feel that, it's an important time for investors to look at some of these interest rate sensitive sectors like REITs, utilities, other high yield dividend spaces that in spite of strong fundamentals have not necessarily performed well over the last couple years due to rising rates. And now there's potential for lower rates to essentially be a tailwind to these areas. So within the report, we have 5 companies that are currently recommended under coverage. We also have a top tier monitor list. So these are 6 companies that are of high value, relatively equal value to our recommended companies. They can be added or used as alternatives to recommended companies. So we have reports on those as well. And then we have our additional monitor list. This is 11 other REITs that are not likely to be added to our recommended coverage in the near term, but they do have strong fundamentals or value, or they're attractive in certain areas, and they could potentially be non-core positions in a portfolio. So anybody who this has been released to our income clients, and anybody who's interested in taking a look at the report can just reach out to us.
All right.
Perfect.
Excellent.
Yeah, something that I would like to note as well, just an FYI, if you're interested in this report, as well as attending our September 5th webinar, how to find the next 10X stock, attendees will receive that report as well. So if you register, you will be able to find that in your account. So just an FYI for anyone who is interested in both, because the REIT report is quite comprehensive. Not only will you get some good information in the webinar, you will also be able to review Aaron's top picks in the space.
Excellent. Okay. Well, in the interest of time, let's move on to our star and dog segment. Our star of the week, ZOMD Technologies, symbol ZOMD on the TSX Venture Marketing or MarTech company. Up huge on the year and in the past month, but this comes off a rather terrible 2022 and 2023. So where's the company at today? It is a business that we have looked at in the past, and Brennan's going to review it as a star and see where we are at today.
You're stealing my thunder.
Okay. Well, your segment's over. Let's move on.
Okay. So I'm just joking. But okay. So yes, the star of the week is ZOMD Technologies Limited, or ZOMD, on the TSX Venture. Like Ryan said, a company which we have been monitoring for several years now. And it initially appeared in our 2022 Canadian cash-rich small cap stock report as a monitor. And today the stock trades at about 39 cents with a $38 million market cap. And again, as Ryan said, they are a MarTech or marketing technology company, which helps advertisers manage performance of user acquisition and engagement. So the stock is up 457% year to date and 156% over the past month. But this follows a horrible 2022 and 2023. And as I mentioned, we have monitored the company for quite some time. And over the past few years, there was an issue as the company was going through several CEO changes, and they ended up revising their fiscal 2022 guidance lower from about 74 to 80 million to 65 to 70 million, eventually achieving 72 million in the year. So they did achieve the high end of their revision lower, but still, that's quite the drop there that we saw. And we also saw growth continue to decline in 2023, where they only produced revenue of 42.5 million, a decline of 41% from 2022. And over this time, we continued to see the company struggle to generate any actual profitability. But anyways, let's take a look at what's driving the recent increase. So the company posted strong Q2 2024 financial results on August 28th, with revenue up 59%. And most importantly, earnings per share was up to 2 cents per share from a loss of 1 cent per share in Q2 of 2023. And according to management, the reason for the increase in profitability was due to the company making some strategic decisions since Q2 of 2023. So a year ago now, including focusing on core user acquisition activities, ceasing operations in certain business lines, and implementing cost reduction measures to improve efficiency. And we will be reaching out to management to see if we can kind of work through the past issues and whether they can continue to maintain growth while preserving this Q2 margin expansion. Now, we did have, we had a few companies in different industries that recently posted breakthrough quarters, which are far less risky in our opinion. As you know, one of these names had a backlog or a significant backlog. We could extrapolate growth into the future, and the other is in an industry which is quite less volatile, which gave us more confidence in management teams of these two businesses. So we will see if we can build the same confidence with ZOMD and ZOMD's management team. Again, the track record has been a little spotty, but the recent quarter is intriguing at the least.
Yeah, the recent quarter definitely gives us a reason to, again, reach out, interview management team once again, and we'll likely do that in short order. But yeah, I mean, you brought it up. We're always looking at not just this one company. We're looking at 10, 20, 15, 50 other companies. And, there were a couple companies that we brought into coverage over the last 2, 3, 4 months that had kind of broken through into profitability. But like you said, there were some other factors at play that gave us a little more confidence in the near term. One of the companies had a record backlog. They've subsequently had a quarter, again, strong quarter, and increased their backlog. So at least over the next 16 to likely 24 months, you saw a good book of business for them. At this point, we don't have a backlog of orders that we're looking at from ZOMD. I'm not even sure how to say it, so I'm just saying.
I always say ZOMD.
Here. ZOMD. I mean it. Yeah. So even the point would be we had more confidence there. Also, there is historical volatility in this company, but also in the sector. Marketing technology companies, it can be just more contract driven. It's typically not like a SaaS business, even though they can have marketing software. It's more, contract driven, can have a really great quarter and then have periods of 2 or 3 that aren't as good. Now, we'll see if there's a change in this business going forward, but it has been kind of a worry in the past, and it has been proven out in the financials in the past. It's a new management team, so we'll see. Relatively
really
speaking,
say like the core thing when we're looking at these like turnaround as stocks is what was the mistake in the past, what was causing that, and is it corrected, or what was the factor at that time? Was it a market aspect? Was it a company aspect? And if it was a company aspect, has it been corrected? Like Ryan was saying, one of the companies we were looking at are both. They've corrected those issues. They've isolated that issue, and you're starting to see that come through in the financials. Is that the case in ZOMD or ZOMD? That's what we're looking for in the next couple of quarters.
Exactly. And can we recommend them and then gain confidence in them as we go forward? Can they then hit it the next quarter? Can management tell us or issue guidance and come in within that range again or exceed it? Can that continue to mount? And can it be a better buy 2 or 3 quarters down the road, or 2 or 3 years even down the road? But if we have some of those items that check off our box, we can put them into our kind of spec buy discovery area of our portfolio, and they can even graduate into being a focus buy over time. But it's good process to move them as they move them up as they move forward in terms of their results and in terms of their performance.
And again, I would just like to, sorry, before we jump on.
Getting ready always. I'm sorry.
Sorry. Just, again, even these companies that we were teasing, we sat down with management team multiple times, and continued to interview them. And the amount of times that we'd sit across from them and they'd be like, when are you going to recommend us? And again, finally, after several years, we did. But again, we need to see that in the business. And, we might do that with ZOMD here. Again,
and sometimes it's several management teams, right?
Exactly.
Like it can be, and there's a flux. And then, one of the companies has brought in a manager or CEO who's running the ship, who really seems to be in a different ballpark from the previous CEO, and really seems to be delivering. Again, 2-3 quarters in, can that continue 2-3 years in? That's where the proof is in the pudding, really. But it looks to be a whole different world under a new management team. That's not always the case, but it does look to be that here. So we'll track ZOMD, and we'll see whether that is the case going forward. Okay, Brett has our dog of the week. That would be Super Microcomputers, SMCI on the NASDAQ, which we talked about earlier in the year.
Yeah, this is the second time I've went through it this year, and I think last time I got a bit of pushback. It was the usual you don't understand the technology type of scenario, which we get whenever we don't like anything that's really anything. Not even just technology, really anything. You don't understand the technology if you don't like it. So I'll get into it. Super Microcomputer, symbol SMCI on the NASDAQ, is a provider of application optimized high performance server and storage solution. The company develops and builds server solutions at scale with its building block solutions. Really, it's a server rack provider. They put together various components from other manufacturers, and then they put them together into certain configurations, and they ship it out to really large databases. So we previously covered the stock in March, and at the time it was trading at $1,085 a share, and it went a bit higher after that, but it was right around the peak when we covered it. And at that time, it was up 283% year to date and up 965% over 1 year. It was really that AI surge success story, which was getting played on the market at the time. It was on all sorts of retail investor boards. It was just, the hype around it was just astronomical at the time. Now, over the past 6 months, we've really seen the opposite. The stock is now down 58% over the past 6 months, trading at $4.52 a share. And I think since I wrote this, it even went a bit lower by the time of closes. Like I mentioned earlier in the store, or in the podcast, the stock market hasn't done great today. And it is now at $26.5 billion market cap. So what has changed? When I was looking at this previously, I did mention the stock was extremely expensive at that peak price during the year. It was at a PE of 85 times, a gap PE, trailing PE of 85 times, compared to a historic average about 19.5 times, and a forward price to sales at the time, because they do release guidance for their sales for the year, of 4.2 times, and that is significantly higher than the historic, which is around 0.6, 0.5 times. So very high, about 8 times of what they would be historically priced at for a price to sales. The gap PE has now, however, fallen to about 22 times, so just above that historic value, but price to sales is still elevated at 1.8 times. That is still well above that historic value, which we saw in the past 5 years or so. And this was really the core gripe I had with SMCI at the time. It was just price to perfection or over perfection for not just the coming fiscal year, but that would require growth well above the previous historic levels for years to come. So when you're looking at these, what we would call, and others would call, price perfection stock, you're not normally looking at just the near-term results of they need to be good or great. They need to be having great, excellent results for the next 2, 3, 5 years, sometimes even 10 years to come. And those are the really, when you're coming from a value investor perspective, that you don't really want to touch. And that's the issue we had. And the company was really riding that AI wave. They still are pushing it themselves, that AI narrative. And as we've seen over the past 6 months or so, that general market consensus of that this AI boom has really tapered off a bit. It's still, I would say, there, but I wouldn't say it's as strong as what we were seeing earlier in the year or late last year. It's not every single headline, every single transcript has AI mentioned 50, 100 times. And it's not that same hype as around which we were seeing. And I think that's really fallen off in that retail investor base, which was really enjoying this stock earlier in the year. As well, since then, we've had 2 quarters and fiscal Q3 and unaudited Q4 statement, which is a important point I want to get into in a minute. For both quarters, sales were within guidance, and for fiscal Q3, non-GAAP EPS was above guidance, and fiscal Q4 non-GAAP EPS, however, was well below what they were guiding at the time. After both quarters, we saw a decline and a short-term negative reaction to the stock price. Something we bring up relatively consistently is sales growth really just doesn't matter until it hits that bottom line, then starts to convert to cash. And you can see that conversion going from sales to bottom line, and as well at the same time to cash, or a very easy way to see it convert to cash. As at the end of the day, that's really what drives both business growth and ultimately what dictates the value of a stock, is that cash flow, is that earnings. And speaking of cash flow, it was negative for both Q4 and the year at a deficit of $0.6 billion and $2.5 billion respectively, causing the company to now fall into actually a net debt position of $500 million, where previously was a net cash position, which is a bit more appealing as it does de-risk a company when you are in a net cash position, as you don't need to raise capital, you don't need to raise debt. And now they're in a net debt position, negative cash flow. It's a little more risky just on the balance sheet side alone. As well, perhaps what was making the headlines a bit more, even though it's only been a fraction of the drop. Last week, the company had a short seller report issued by Hindenburg Research. They covered things like the Danny Group. They had another big one, which I'll put on the screen. The name escapes me right now. The point of the report that they issued, which they allege, I'm not going to say that they're fact at this time, is many short sellers, they really play up the facts. Even if they are a fact, they really want to make it underline it and point to a million different things. So the main 5 points they had: channel stuffing and early recognition of revenue, which inflates sales figure. This is fraud. Rehiring of previous senior staff who were removed due to SEC charges in 2015, and then they were charged in 2018 for premature recognition of revenue. So same thing as what they're alleging that SMCI is doing at this time. as well as related party transactions worth $1 billion between family members of the CEO, as well as undisclosed related party transactions. Further, product issues such as incomplete products being received, bad reliability, as well as increased competition from the likes of Dell and HP, as well evading sanctions against Russia through various shell companies. It is uncommon, like I was saying, for short reports to have a myriad of reasons with varying validity and importance, and this report is no exception. However, the company has now delayed its 10K or its audited result, which really to me and most of the market means that there is some validity to the short report. To what degree and what point, it's the question at this time, as obviously when you're discussing things like fraud, you're going to have pushback from the company, whether it's true or not immediately. That's going to be the first news post, is they're dismissing the report, but whether it's true or not, it will come out 6 months, a year from now when this 10K is filed, which occasionally you do when you see fraud cases. If the fraud is true, the 10K might not be reported for another 3 months, and that can just have a gloomy nature around the company for the next 3 months, year, depending on how long it takes. And depending on the company, you can really just leave that aura of negativity, even if it does not come out to be true. However, the stock fell 19% after this after the short report was issued and the 10K was announced to be delayed, leaving it in this current $450 or so price range. As well, a quick aside, when you see these fraud cases involving accounting manipulation on the sales side, cash flows normally aren't impacted to the same degree, as cash is harder to manipulate, as it's effectively in the bank or it isn't. So if the auditor is doing their job, they can see the cash is in this bank account or not. Where sales recognition, it gets more complicated and it's harder for auditors to catch even. So it's more commonly that's manipulated over the cash. So if you are saying, oh, I don't want to look at fraudulent companies, you become a value investor as you're looking at cash flows ultimately. And that's really where you see these fraudulent cases, is these massive high growth companies. They're selling you the story and is ultimately just fiction, as it's easier to fake sales. So just to summarize, the stock, in my opinion, was very overvalued 6 months ago, and the following quarters were just not that same explosive growth that the market was really expecting, even if it was within guidance, which is what we mean when the stock is really priced to perfection. You can't just have average results. You need great, excellent results quarter after quarter, year after year, until that valuation is actually more reasonable again. Further, the AI theme boom seems to have really waned, driving less money into the theme. And last but not least, the accusations of fraud and just the other 50 things they highlight. I only highlighted the headlines there. It's a very long written short report, which ultimately it results in the delay of the 10K, so it at least has some sort of validity. Overall, not just the share price, but potentially the entire business was built really on a house of cards, which now appears to be at least wobbling a bit, if not collapsing, making Super Microcomputer our dog of the week.
Yeah, sorry, Aaron, I think you're muted.
I was looking at the analyst expectations on Supermicro, and so after doubling earnings last year, it looks like analysts are still expecting 50% earnings growth this year and then another 40% earnings growth next year. So this is non-GAAP. But then, that's about 1.3 billion in non-GAAP earnings reported for last year. But as you noted, negative cash flow, negative 2.5 billion in cash flow. So, I mean, that would be a major concern. It looks like it's a company that has really good growth, but they, the fact that they weren't able to translate that into positive cash flow is something that you need to look further into for anybody who's considering an investment.
Exactly. And really the other factor, which I would say at play, and I will just, before I get into that, that's based off the audited results that at this point could change.
Yes.
So yeah, that is something you should be aware of. Even me saying 2.5 billion negative deficit, that could end up changing as well. Mm-hmm. And as well as the sales figure, which they have reported, it could end up changed after they're audited. But the other factor, which I would really say, is that margin decline. It's server racks. It's a relatively commoditized business. It's not like an exact commodity. It's not an oil or gold or something, but it's a very low differentiation. They're really putting these components together. They're not the one who's really innovating. They're doing a bit, but it's not like this drastic difference. That's why you have Dell and HP SMCI was really the first mover, and now you're starting to see this first mover advantage start to disappear, really, and that they had really inflated margins over when you were looking at it earlier in this year. And if that does start to come down, that's why you have such a high sales multiple right now. And if that does start to come down to historic levels, you're looking at a quarter of the value it is right now if the margins do start to collapse during the next year or two.
Yeah, you said price to sales was 0.6 in that range, and
historically.
Yeah, and like that again for the business that they're in. When this is not a SaaS technology company that has a massive moat around it or anything. I mean, they look, like you said, it looks like a first mover who took advantage of that, and good on them for doing that. But do you deserve 80 times, 70 times, 60 times earnings? And it is interesting to see now the PE start to trend back to the price to cash flow, trend back to like their 5-year, 10-year average. But the price to sales is still elevated. And if you see a margin situation that continues to correct, that's where you can really get in trouble when you're holding a company like that. And you had a great run, but if there's nothing to protect their margins, that's an issue. All right. I think that's going to end off our show for this week. Keep your questions coming in for our Your Stock, Our Take segments. We'll continue to answer those on a weekly basis. And if you want to attend our upcoming webinar, again, September 5th, 4 p.m. Pacific, right? And 7 p.m. Eastern. We got that. There is a full live 5-hour webinar on September 21st. So if you've been listening to the podcast for weeks, years, months, comfortable with what we do and want us to help you build a simple 15 to 25 stock portfolio, September 21st, 5 hours, we'll go through 15 to 25 stocks as well to help you start building that portfolio. Again, as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.
Smash that subscribe button.